There is a number that will haunt you once you hear it. One number, and it will change the way you look at every stock, every market, every financial headline for the rest of your life. In the 13 years that Peter Lynch managed the Magellan Fund at Fidelity, he turned a modest $18 million fund into a staggering $14 billion. That's not a typo. That's not luck. That's not a bull market riding everyone to glory. That's a man who found something the rest of Wall Street was too arrogant or too blind to see. But here's what nobody talks about. Here's the part they leave out of the business school textbooks and the TED Talks and the glossy magazine profiles. At the absolute peak of his power, when Peter Lynch was the most celebrated fund manager on the planet, when people were throwing their life savings at him, when the media was calling him a genius, a magician, a god of the market, he walked away. He quit. He turned his back on billions of dollars in potential future earnings. And the reason he gave? It would make most people on Wall Street physically sick to hear it. He said he was missing his kids growing up. That's it. That's the reason. And yet somehow, buried inside that decision, inside the philosophy of a man who chose family over fortune at the height of his powers, lies the most important investment truth of the last century. A strategy so devastatingly simple that the Wall Street elite have spent decades trying to convince you it can't possibly work. Stay with me, because what you're about to hear is going to change everything. Before we go any further, I need to ask you something. Do you think the average person, someone with no MBA, no Bloomberg terminal, no Wall Street connections, can actually beat the professionals at their own game? Drop your answer in the comments right now. Yes or no? I want to know what you believe before this video is over, because I promise you, your answer is going to be different by the end. And if you're new here, hit subscribe and tap that like button. We dig into the stories they don't want you to know about. Now, let's go back to the beginning. It was 1944, a cold January in Newton, Massachusetts. Peter Lynch was born into a world that had no particular reason to celebrate him. His father, a mathematics professor at Boston College, was a steady, quiet man. Not rich, not connected, just decent. But when Peter was 10 years old, the floor fell out from under his world. His father was diagnosed with brain cancer. 3 years later, he was gone. Peter Lynch, age 13, was now the man of the house. His mother worked. Peter caddied at a golf course nearby, the Brayburn Country Club, hauling bags in the Massachusetts heat and cold, earning a few dollars at a time, watching rich men talk about money the way other people talk about the weather. Casually, confidently, like it was all just a matter of knowing which way the wind blows. One of those men changed his life. A Fidelity executive named D. George Sullivan took notice of the quiet, serious caddy who actually listened when the adults talked. Sullivan eventually helped Lynch get a scholarship to Boston College. And it was there, studying history and philosophy, not finance, not economics, not accounting, that Lynch began forming an idea that would one day make him a legend. He noticed something that his professors in the business school would never have admitted. The stock market, for all its complexity, for all its jargon and its algorithms and its endless noise, the stock market was, at its core, about stories, about businesses, about people, and the best stories were hiding in plain sight. Here is where the strategy begins to reveal itself, and it is going to sound almost insultingly simple. Lynch joined Fidelity as a research analyst in 1966. He studied companies, hundreds of them, thousands of them. He visited their factories, walked their store floors, talked to their employees, ate their food. While other analysts were staring at spreadsheets in fluorescent-lit offices, Lynch was out in the world, touching reality. And he started noticing a pattern that defied everything the efficient market hypothesis said was possible. Ordinary people, regular consumers, knew which companies were great before Wall Street did. They knew because they were living it. Think about that for a moment, because this is where everything gets dangerous for the establishment. Lynch would later describe it like this. He was walking through a mall with his wife Carolyn in the late 1970s when she mentioned that her friends couldn't stop buying this product, couldn't get enough of it. The stores couldn't keep it on the shelves. The product was from a company called Hanes, and he noticed that women everywhere, not analysts, not fund managers, not CNBC commentators, women everywhere were going crazy for legs pantyhose. So Lynch looked into Hanes, and Hanes became one of the greatest investments of his career. This was not a coincidence. This was a system. He called it invest in what you know. But that phrase has been so watered down, so misquoted, so stripped of its real meaning, that most people have completely missed the point. It wasn't a suggestion to just buy stock in your favorite burger joint. It was a radical philosophical declaration. It was Lynch saying, your everyday experience, your life, your shopping cart, your observations, your gut feeling about a product that everyone around you is obsessing over, that is more valuable than a Harvard MBA when it comes to finding the next great stock. Before the analysts even open their laptops in the morning, you have already lived the research. And now we arrive at the number that ties it all together. The number that Lynch discovered through years of pattern recognition, thousands of company visits, and a mind trained in history and philosophy rather than pure finance. The number is called the PEG ratio, price to earnings to growth. And in the right hands, this one metric became a weapon that consistently, almost ruthlessly, separated the true opportunities from the Wall Street noise. The concept is simple. You take a company's price-to-earnings ratio, the standard measure of how expensive a stock is relative to its profits, and you divide it by the company's earnings growth rate. If a company has a P/E of 20 and is growing at 20% per year, the PEG ratio is 1. That is fair value. If the PEG is below 1, Lynch called that a potential gold mine. The market is underpricing the company's growth. And in Lynch's world, that was the trigger. That was the moment to act. The moment most of Wall Street was still looking the other way. But here is the twist that no one prepares you for. And this is the part that separates Lynch from every other investor who ever tried to copy him. Lynch was not just looking at numbers. He was looking at stories. A company with a great PEG ratio and a boring, unsexy, completely unglamorous business? That was his favorite kind. He used to say that the ideal stock was one that no self-respecting analyst would ever recommend. A company that made something mundane, funeral services, auto parts, waste disposal, something that made people at dinner parties change the subject when you brought it up. Because if Wall Street wasn't paying attention, if the sophisticated money hadn't piled in yet, if the stock was still cheap and growing and misunderstood, that was exactly where Peter Lynch wanted to be standing. He bought Dunkin' Donuts. He bought Taco Bell. He bought Lockheed Motor Ends. He bought companies that made him laugh when he explained them to his analysts. And those companies made his investors rich. Spectacularly, life-changingly rich. At his peak, Lynch was delivering returns of 29.2% annually for 13 straight years. To put that in human terms, if you had handed Lynch $10,000 when he took over Magellan in 1977 and left it there until he retired in 1990, you would have walked away with over $280,000. Not from some wild speculative bet, not from crypto or options or leveraged derivatives, from boring companies that made donuts and tacos and roadside motels. But now I need to tell you about the moment the whole empire nearly cracked. Because it did crack. And the way Lynch handled it reveals something about the strategy that the highlight reels never show you. In October 1987, the stock market collapsed. Black Monday. The Dow Jones dropped 22.6% in a single day, the largest one-day percentage crash in history. Magellan lost more than $1 billion in value. In a single afternoon, Lynch was on vacation in Ireland with his family when the crash began. He got the calls. He felt the weight of it. Millions of ordinary Americans who had trusted him with their savings, their retirements, their dreams, watching the numbers fall like a stone. The pressure was unlike anything most human beings will ever experience. And what did he do? He came home. He sat down. And he did not sell a single thing. Because Lynch had already lived through 5 major market declines before 1987. And he had noticed something that the panic sellers never stopped long enough to observe. Every single time, the market had recovered. Every crash in history had eventually become a footnote. And the people who held on, who trusted the stories behind the businesses they owned, who did not confuse the price of a stock with the value of a company, those people came out the other side stronger, richer, wiser. He once wrote that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Read that again. The fear of the crash is more dangerous than the crash. That is not a slogan. That is a hard-won truth, carved from 13 years of navigating markets that tried to destroy him and failed every single time. And then he walked away. 1990, 46 years old. The most successful mutual fund manager in history, at the peak of his powers, with investors practically begging him to stay. And he chose his daughter's school plays over the S&P 500. He chose Saturday morning pancakes over portfolio reviews. He chose life. And in doing so, he delivered one final lesson, the one that the strategy was always really about. Investing is not the point. Life is the point. Money is a tool, not a destination. The greatest investor of his generation understood that better than anyone who ever came after him. So what do you do with all of this? You start looking. You start paying attention to the products your family can't stop talking about. You look for the boring, ignored, unglamorous companies growing quietly in the corners of the economy while Wall Street chases glamour. You learn the PEG ratio. You hold on when the market screams at you to run. And you remember that the edge was never in the algorithm. It was never in the hedge fund. It was never behind a glass tower in Manhattan. The edge was always in ordinary life. In a shopping cart. In a conversation at a dinner table. In a pair of pantyhose at a grocery store checkout. Peter Lynch didn't just build a strategy. He built a philosophy. A way of seeing the world that puts the power back in the hands of regular people. People exactly like you. And the most remarkable thing? After 35 years, it still works. The market is still irrational. Companies are still misunderstood. And somewhere out there, right now, is the next great stock, hiding in plain sight, waiting for someone paying attention to find it. The question is whether that someone is going to be you.